Hello, good morning, everyone. Welcome to the group account class, and my name is Ogunribokunbamidele Emmanuel, um, one of the directors at Risk Free Standard Associates. Today, we will be looking at basic group accounting, and in the last class, this is the basic group accounting 2. In the last class, we're able to have looked at some things that we look at what are the fundamentals of group, what's the definition of group. We're able to look at some group items that we considered. Today, from the last class, we said we'll be looking at the 5 keys when we are asked to prepare group accounts. And those 5 keys, as we have laid down in the last class, we'll just look at them as they operate now. We said that the 5 keys working for consolidation of statement of financial position, as we have said in the last class, when we talk about the financial statements include the statement of financial position, statement of profit or loss, and other statements. Also, as well, we'll talk about the cash flow statement. So what we'll do is that we make sure that we get the fundamentals. So I don't want to let you guys think group is very difficult. So let's start with the one that, what can I do if I have an exam? This is actually related to people who are doing skill and people who want to also sitting down for ACC exam, which is the F7. And again, even a prelude for those people who are also preparing for ACC diploma. So we have these 5 keys of consolidation. We are saying that the first step is talking about the group structure. What is in the group structure? This is what we have looked at in the last class, but we are still going to be looking at it. That how do we talk about group structure? Then next, we'll look at it in that group structure. What are the information we'll be looking at? Show the interest of the parents and the NCI in the subsidiary. That's what gives us the group structure. In order to make this class more interactive, we are also going to have a working note to be of help to us. So let's just check and get to the working note. So in this working note, we'll be saying some things that we need to understand. And in the class, like what we have said, the first thing we have looked at in that place, we are saying what is called the group structure. When you talk about structure, we are looking at something that has its own entirety. And looking at it, so when you talk about structure, let's take a this. This is a company. The company is actually valued based on what we call the units of shares. For this class, we'll be considering the unit of shares to be in 2 instances. We have what we call the ordinary share, and we have what we call the preference share. The ordinary share is actually referred to as, most time, let's say in a local palace, we say those that are the owner. We talked about them as the risk bearer. Why these preference shares? For further explanation, you see that is having an element of equity and debt. But under the ordinary share, we are only having that of the equity. And in that case, when you look at this, I will be considering that, let's assume this is a company X, and it has its ordinary share to be 100%. Now this 100% is telling us the share of the company, which will always be in units. For example, we look at it in terms of what we call share capital, and then we are told maybe at 1 naira for those that are Nigerian students, you have it to be 10,000. So this is an example of what you get to see. So when you are now looking at this and the company decided to come, which we have discussed in basic 1 of this class, the company decided to acquire this company. When such occur, what you get to see is that the company will be acquiring percentage of this unit. And just to move very forward, we look at it, we said that there will be the company who is acquiring, which is called the parent, and the company that will be acquired is called the what? subsidiary. So the company that is acquiring the other company is called the parent. With the percentage holding, we have the date of acquisition, and we also have to see if it's not fully acquired. We look at it where we talk about the NC percentage, and this we have done in basic one. So this is group structure. So just to remind you of what we've done in the other class. So let's go back to our slide. In this slide, we have said that shows the interest of the parent and NCI. Then number next, what we also see is that the group structure shows the date, either now of this date when the subsidiary is acquired, which is very fundamental as we move on in the class. We also have a situation whereby the second thing we look at is what called the net asset of the subsidiary. When you look at the net asset of the subsidiary, that also takes us to our work note. Let's see, a lot of people will say, what is the net asset? Let's just quickly let's go basic accounting, our basic accounting structure. Remember those days you get to hear asset is equals to capital. That is what we have when we are starting accounting. From there, we're told that assets, from the concept, it moves on to asset equals to capital plus liability. That means a company that cannot move, that cannot fully pay for its assets, so it might go liability. Now, this standard, which is actually the key standard of accounting, we have it to be 5 key points, but we're looking at these 3, which has to solely be something that affects the statement of financial position. So in this case, what do we look at? We can rewrite this formula by saying asset minus liability is equals to capital. Asset minus liability is equals to capital. And when we are looking at capital here, we are looking at what we call equity plus reserve. Equity plus what? Reserve. And that is what we get to see. Now, this equity plus reserve, in looking at this guy, in looking at these 2 elements of asset minus liability, in another part, asset minus liability is also referred to as what we call the net asset. So, which simply means that when you are looking for the net asset of an entity, the net asset of an entity is the difference between the asset and liability. But for consolidation process, it will be too cumbersome for you deducting the asset from liability, and you start having issues. These you get to see in the old standard where we are looking at business combination. But with the new standard, as we have done in the previous class, IFRS 10, we get to see that we relate to what we call net asset. And in that net asset, we'll be looking at the equity component, which comprises of equity and what? And the reserve. So what are the items that we have under these equities and all the rest? So when we are looking at this, we are looking at things that we refer to as share capital. Underline the fact, ordinary share. Then we are also looking at what we call the reserve. But in most of the exam, the word reserve here is going to be described as what we call the retained earnings. So that is what you get to see under asset and what we refer to as the net asset. So when we move on, you start seeing more of that. Then we get to see the net asset. After the net asset, so what do we have? On the net asset, you see at the date of acquisition, we also have what we call, in order for us to get to that goodwill, we are still going to look at all these principles popping out and as they move on. Then represented the share capital. I'll have to quickly point our attention to something, and I want us to have this because I have a student that asks a question now. The first step is described as what we call the group structure. The group structure. And this group structure is the working one. Like what I said, there are 5 steps. This is the parent, this is the percentage holding, and this is date of acquisition. We have the subsidiary. Now, this is the first information we have. We now said the next information is for us to get the net asset. And from what we have there, the net asset is an information. We are looking at it. This is working 2. Net asset of the subsidiary. So when we are looking at the net asset of the subsidiary, from our slide, we could see the information that we're told that we need the net asset at the date, at acquisition date, either, and also the reserve at the point of the date of reporting. So in that case, when we are looking at the net asset, when we are asked to solve consolidation, we need the net asset information at date of acquisition. We also need the information at the date of reporting. In some other clients, they refer to this as date of consolidation. So what are the components of the net asset? What are those components? What are the things that is going to be in the net asset component? We've already said that includes our share capital. That includes our retained earnings. The student said, is that all? I will say for this basic class, that's what we're going to deal with. However, you could have another situation that the reserve is not going to just be the retained. So for the reserve, there's also another unique feature of reserve, which we refer to as the share premium. So after that, we'll go back to what we have, and which is the general one. We'll look at what we call retained earnings. A question pops up now from a student. He said, why am I not having general reserve? Excuse me, general reserve is not something that we're going to be saying when you are preparing your group account. General reserve is something that relates, are we there now, to but in looking at the fundamentals we have now, for your exam now, you get to see more of retained earnings. Now, you have whatever is the amount of these elements on the date of the acquisition. You have them. Then I can look at this as retained earnings. Now, another fundamental you get to see is that there will be another value for some of them, or particular one at the date of reporting. For example, your share capital, put it at the back of our mind that this is basic group. You see that the share capital on that day of acquisition will be the amount on the date of reporting. The share capital on the date of the share premium on the date of acquisition will automatically also be the amount on the date of reporting, because that is the amount you have. Practically speaking, for your exam, let's just see that. In your exam, the examiner will only give you the share capital and share premium on the date of acquisition. On the date of reporting, which is always stated in the question. You see that these are usually stated in the question. They are stated in the question. So how do I get it? They are always stated in the question. So for me to now know what is the amount at the date of acquisition, I just need to infer. So whatever is the amount at the date of reporting will be the amount on the date of what? Acquisition. Then for the value of retained earnings, you have the retained earnings that will be given to you on the reporting date, using this as a symbol. While the amount on the date of acquisition will also be provided, there are sometimes that you have to calculate. Now, having seen these two scenarios where we are going to use our ability to be able to determine what is going to be our post-acquisition reserve. Post-acquisition reserve. And the rule says for us to get our post-acquisition reserve, which we are going to look at here, note, how do I get my post-acquisition reserve? From the word post, when you talk about the word post acquisition reserve. It means something after. So in this case, it means what is the reserve after the date of acquisition. So basically, it means you are comparing all your information. You are comparing all your information on the date of reporting with all your information on the date of acquisition. For your information, this has been tested in the exam. ICANN exam have tested something like this, that students were asked to calculate goodwill and then calculate the group retained earning. So you could also have it in the situation that what is post acquisition reserve. For those of us doing F7, you get to see something like this. That means that is your net asset on reporting date okay, net asset on reporting days less the net asset on acquisition date at acquisition date. Okay, let me bring this out in a bigger picture. Computation of post acquisition reserve. The rule says it's going to be net asset of subsidiary at reporting date less net asset of subsidiary at acquisition date. And please be guided, your answer could either be positive or negative. So that is all we have. So quickly we go back, so I can easily do this. This minus this will give me this. This minus this will give me this. This, which is the amount on the date of what? Of reporting, I'll be deducting it from this. So this could either give me a positive value or a negative value. And at the end of the day, I have my values as they should be. This is AA and this is what? RR. And I either have P or P minus. So negative. Which is something that I can decide to rewrite here. From here, I just tell you that this is my RR as what we have done there, AA, and at the end of the day I have P or negative P. That is what we refer to as that value. So let's go to the next fundamental. I haven't looked at that. We look at the next item, goodwill, which we are also going to look at them one by one using the fair value method, and then we look at NCI. Then we look at what is the group retained earnings. So these are the 5 keys of group, consolidated group. So if we are looking at these 5 keys, let's look at them. We have said the 5 keys include: number 1, we have what we call the group structure. Number 2, we have what we call the net asset. Number 3, we have what we call the goodwill, which we are going to explain in detail. And when we are explaining the goodwill, we are going to explain it in detail with what we call the NCI, because there are 2 forms of goodwill. You have the full method and what we call the proportionate method. Then at the end of the day, we'll be looking at this as we have it go. Now, having gotten all these 5 steps, I want you to quickly just do a check. What are the 5 steps that we have? Step 1, group structure. So we have the step 1, which is the group structure. What are the key things that we look for in the group structure? Our ability to be able to know what are the things that we need to look for in the group structure is what we have said earlier. The group structure, we have the parent, subsidiary, and well, if it is not fully owned, NCI will exist. And how do we get NCI? I said NCI is the residual value. Okay. In looking at the second step, we went through the definition of key terms in accounting for us to know what is called the net asset, and for us to know what are the components of net asset, so that we'll be able to know what are the fundamentals to be considered. Then from there, we'll look at the picture of what net asset of a subsidiary will look like and how a question can be around this element. So one other thing we need to now look at, which we have seen earlier today, is also the goodwill. So let's quickly look at goodwill. Looking at goodwill, and look at goodwill in terms of its own rule. We are saying that the third picture. So goodwill. Looking at goodwill, simple term, computation of goodwill. Let us go straight. Is comparing what we call the cost of investment. Cost of investment which is payable by both the parent and the NCI. This is, we are looking at goodwill in terms of full method. And please, in this full method, we are looking at it at fair value. When we get to NCI in detail, we'll get to see more information about that. And then we'll now compare what we call the net assets of subsidiary at acquisition. I like at this point to quickly point your attention to something. A lot of you will just write net asset. What the standard actually underline is the word fair value. The fair value of net asset of subsidiary. So when we get there, we'll get to know what we're. So what we're going to have here at the end of the day is referred to as our goodwill. So these are goodwill. Someone asked me now from the chat, how about I have negative? There's nothing called negative goodwill again. The word is now referred to as what we call gain on bargain purchase. That's what we have. What we are doing at this stage is to identify the elements, components of what we are having. Having looked at goodwill, we'll move to the next item that we said earlier here, which is the non-controlling interest. The non-controlling interest is also a vital point that we need to understand. So when we are looking at non-controlling interest, like what I've said earlier, the non-controlling interest is something that we use. Are we there now? Is also part of the owner of a business. Like what we have said earlier, that the non-controlling interest is something, group of people, not something actually, because the standard describes them as set of group of entities either that owns the residual of the parent company. So when it comes to NCI, which is the NCI, the fundamental rule of NCI is for us to be able to know the NCI value at reporting date. That means what is to be consolidated. The first element we need there is the fair value of consideration. The fair value of consideration. Usually, these amounts would have been computed while we are getting a goodwill. So that's the same value. Then you add everything that he has gained from the subsidiary. So we'll talk about plus post acquisition reserve from subsidiary. And how do we get the value? That will be NCI percentage times the post acquisition reserve. That is what we have. Where there are situations that there is goodwill, we will be taking that. Now there could also be, if any, there could also be what we call impairment. Loss. So we'll take the NCI percentage. All these are just the format. There could also be other adjustments. So this one to if any. So as you move ahead, you get to see us look at them one by one. So the fifth one to quickly make our class is what we refer to as the retained earnings. I will use the real description, which is called group retained earnings. And the group retained earnings comprises of what we call the parent retained earnings on reporting instruction at reporting date, then addition of all what is getting from the subsidiary. So what are the things getting from the subsidiary? We have the post acquisition reserve, the post acquisition reserve, which is something that we need to look at. The post acquisition reserves, which will be attributable, will now be the parent percentage times the amount that we have calculated earlier. And this amount, we have it there. Then we also have other adjustments. For now, we'll only be considering what we call impairment loss. So that is what we have for the basic rule that I've said here. And having known this basic rule, it makes you to know what and what that we need to understand. If there's any question on this, you can easily just call my attention. I'll get to meet next class. Thank you. I did not record.